Let's start on the tweaking of the financial targets. Is this about growth? Is it about cost cutting? What is the message for investors?
It's about both. Actually, we want to reiterate the story that while we have always to look at ways to become more efficient, and we are doing that, the real story for us is how we free up resources through cost initiatives to reinvest in our business. And that's the reason why, if you look at our plans, we expect our cost base to stay flat, excluding variable compensation that is performance related, and grow our top line. And so growing the top line is sustained by two secular trends that we are experiencing: wealth creation and wealth transfer in the world, and also the opening up of China as a financial market. And in general, we do see those two forces allowing us to grow at least as much as the real GDP growth globally.
All right, let's talk more about growth then. Where's the growth going to come from in global wealth management, particularly in the US?
Well, actually, in the US, our next focus will be on developing more our ultra high net worth offering, and enlarging and bringing our expertise that we have globally on that area, together with the family offices capabilities that we already have, into the US, and tapping a market that is very promising for us and that is under-tapped, honestly, for UBS. The second areas of growth for us is that we didn't really touch the US persons outside the US in the last 10 years, and I think this is also a very nice opportunity. We do expect around 70 billion of inflows in the next 2 or 3 years to come from that segment of clients.
Oh, interesting. So talking about expats there, and in wealth management, all regions did book inflows except the Americas. So in the US, what can you offer clients, particularly in global wealth management, but also in other areas that your US competitors can't?
Well, I think it's really this. First of all, I would say that our inflows and outflows in the US are broadly in line, actually are in line with industry standards. If you look at our US competitors, don't report net new money, but the best proxy to understand inflows and outflows on a competitive basis is to look at invested assets, and we have been growing in line with our peers. So one can assume that we had the same kind of behaviors in net new money. In terms of the competitive, what we can offer is really these capabilities that we have outside in the US that makes us unique. We are the only truly global wealth manager in the world. So it means that we have leadership positions in all main markets. Not only in the US, we are a top player, but also in Asia and Europe and Switzerland. So we can bring the expertise of investing globally, and which is very complementary to some of our competitors.
Got it. In global wealth management then, what a lot of investors have been focusing on is what's going to come from the cost cuts. There was some tweaking around the cost targets today. Just talk to me about that. First of all, how should we interpret them, and how are those cost cuts going to come about?
Well, the costs are, as I mentioned before, is a function of becoming more efficient. And when you look at our cost base, one thing is going to stay fairly stable is investment in technology. And investment in technology is allowing us to take down the rest of the cost base in the bank front to back at around 2-3% a year. But the most important issue is that what do we do with those cost savings? We reinvest for future growth. That's the very important element. Our story is not about cost cutting. Our story is a combination of efficiency in how we manage our resources and how we manage our balance sheet. So the trade-off for us is the frontier of efficiency between capital returns and cost-income ratio, where we are one of the best in the world.
The buyback program is running ahead of plan, and you have said today, don't confuse one buyback program with our ambition and potential. So throw this forward for me. What is the potential for buybacks? How ambitious can they get?
Well, obviously, first of all, let me clarify that statement, because it means that under Swiss stock exchange rules, we have to declare an amount, and within 3 years, we need to complete a program. And that has nothing to do with the cash flow that we will generate over 3 or 4 or 5 years. So, and we are announcing every year our ambitions. At the beginning of the year, we said we're going to buy back 550 million. We already exceeded that target as we speak with 650 million worth of shares that we bought back. And in January, when we announced our dividend for 2018 that we paid in 19, we will also announce our share buyback intentions for 2019.
Got it. So you've already exceeded the target. So let me push you a little. Does that mean you then slow down or you speed up from here because you're already ahead of your own target?
We will, it's very clear that we will not retain capital above what we indicated as being our target operating capital levels for regulatory reason. So the 13% CET1 ratio and around 3.7% leverage ratio. If we don't need capital for growth and to be invested in business, we will return it to shareholders. So, and I think that we let the market and analysts calculate what it is, and only on a yearly basis we will announce exactly what we do, because of course there is always some visibility that we want to have, we need to have about future developments.
Okay, so let's talk about the market then. We understand, Bloomberg does, that some investors have expressed concern over the share price performance. I know it's up today, but year to date. Are investors mispricing UBS?
Well, look, it's always very difficult. Every CEO likes to think that their stock is underpriced and not fairly treated. But so what I can look in an absolute basis, of course, it's very disappointing to see the stock being down. But what is very important is to see how is our stock performing vis-a-vis our competitors. So the stock is down, but it's down on a total shareholder returns less than our reference competitors. And so if I look where we trade in terms of multiples, both on a price to tangible but also on a price earnings basis, we are trading at a premium to our European peers and very close to our US peers. So yes, I think that over time the market and investors will eventually recognize the value of our franchise and the highly cash flow generative value of our franchise and the diversification that we put on the table.
You always talk about the diversity of UBS's business. So let's talk investment banking as well. Outperforming wealth management again in the last set of numbers. Which parts of the investment banking business model are most attractive for UBS right now? I mean, you had double-digit gains in equities, but also in fixed income.
We are a very focused player in the investment bank. In 75% of the areas where we compete, we are top 5 globally. So we compete with the best in the world, where in those areas where we choose to compete. And it goes from execution and advice in research, equity trading, equity derivatives. It goes into FX, where we are one of the largest players in FX in the world, to on the other side, M&A, advisory, ECM capabilities. So our sweet spot are those activities within the investment bank where we don't want to, we are not aiming to be a large offering, a bank offering all the products, but actually we want to stay very focused and really on that side, always making sure that not only we give the best service to clients, but also we have an adequate return on capital for shareholders.
We talk in the midst of a global equity market sell-off. Yes, a little bit of a reprieve in European equity markets today, but generally equity markets globally have been down in October. You've talked before about the impact of trade wars, for example, on client activity. Do current market conditions pose a risk to UBS's profit?
Well, market conditions, we have been going up on ups and downs in markets. I think that it's fair to say that, yes, U.S. markets have corrected, but broadly speaking, we are flat year on year. So, more than market corrections, what is really impacting our business is activity levels of clients. So in that sense, you can expect that if there is any correction in the market, which is physiological, by the way. I mean, we have been going through a long bull markets, and if there is any adjustments, it's quite physiological. I think it may be well compensated by an increase in volumes or at least volatility in the markets, which is quite positive for our business. Also, as we move more and more away from transaction-based revenues to fees-based, through mandates, through lending, and so on, we are also diversifying our revenue portfolio. And as I mentioned before, we are also planning to grow and tap into new opportunities. So what the so-called beta factors, so that we can control interest rates, market developments, can be offset by managerial actions in tapping to new markets and new clients.